All right, hello everybody, and welcome to our 14th webinar at Holmquist and Gardner. This is a pretty exciting webinar, the rebirth of multifamily again. We'll talk about our guest in a moment, but before we do, Holmquist and Gardner, obviously a business and real estate law firm. We focus primarily in business and real estate transactions and litigation surrounding business real estate issues like construction, employment law, and general contract disputes. And we're here to provide comprehensive representation and be a place where you can be valued and your matters get the attention they need. One of our key priorities and core values is sort of constant urgency. We try to get back to people quickly, make things happen quickly, and maintain a spirit of positiveness about it. With that, just like to remind everybody that today is informative only, not meant to be legal advice. As with anything, we advise you to seek independent counsel with regard to your specific matter. And as we discuss the stuff today, go ahead and take notes. And if you have questions, happy to reach out to it'd be great if you reach out to an attorney at Holmquist and Gardner or elsewhere. But again, don't rely on this for legal advice. So with that, super excited to introduce one of my great friends and colleagues that I've had the opportunity to work with over the past 10 years or more, Tim McKay, who has 15 years of experience in multifamily, started back in 2006 at Marcus & Millichap. Now he's at Colliers, heading up the Pacific Northwest multifamily team. Tim does everything from garden variety multifamily investment properties to more traditional townhome sites and student housing, some of that stuff that's out on the periphery. About 40% of his transactions are land, and the other 60% are existing multifamily. We've had the great pleasure of working with a number of his clients and on a number of projects. Tim demonstrates the highest level of integrity, skill, and ability. Getting the deal done is really second to making sure the deal is done properly and in an ethically upright manner. So with that, Tim, thank you for joining us, and let's kind of dive into our topics.
Thank you, Mons.
So as we noted in our headline, the rebirth of multifamily, we've got a very pragmatic approach to this. Tim and I share the fact that we're just not going to run and hide from the obvious issues that are facing Seattle. So we'll start by talking about some of the sort of negative issues in Seattle and King County generally in the political climate. Then we're going to get into a lot of the positive stuff, buying in Seattle, why now is a good time, and then what are the things driving that, and get into sort of why we think we're heading into really a rebirth for multifamily. So with that, Tim, why don't you walk us through maybe the previous 15 years in the local community and kind of where we're at right now with regard to the political climate.
Yeah, thank you, Mons. Getting into the business 15 years ago was an interesting time to cut my teeth at Marcus & Millichap. The big news, what everyone was selling their apartment buildings for, was for condo conversions as the condo market was hot. Deals were moving quickly, and as I was trying to figure things out. But it really wasn't a ton of institutional money at that point. It was a lot of local, regional developers, condo converters, not a lot of people doing flips where they'd come in, renovate units, and then get them back on the market to sell. So a lot of the sales that were taking place back then were for condo conversions. And it was about 15 years, 14, 13, I guess, coming out of the downturn that we really saw a lot of institutional money start pouring into Seattle. And that's when the game kind of changed, I'd say. I feel like Seattle couldn't keep up with the demand for new apartments. So whether it was institutional developers who were building throughout the city on the outskirts, a lot, obviously South Lake Union, downtown, Capitol Hill, or it was institutions just coming in and purchasing existing assets and putting money into units, repurposing them, and either holding them, putting long-term debt on them, or selling them. We started to see Seattle become a really popular market. And for that reason, and a lot of the reason why we've had more cranes up in the city for the past 6-7 years than anybody, is we've created more jobs than anybody, high-paying jobs, and similar to like a San Francisco, We don't have a lot of land. And so with the land constraint, we're able to, we don't have a lot of place to put the supply, and the demand's increased. And so rents have just skyrocketed. And so a lot of what we've done over the last, call it 10 years is source dirt for developers. And that land is obviously probably, tripled in value. And it was only 20 years ago that we were selling apartments for $100,000 units on Capitol Hill. So a lot of this institutional money has, one, pushed value throughout the city, but it's also pushed rent. It's also forced these regional and more private investors to step up and pay higher prices too. And that's kind of what's driven this market. Obviously the condo market's not with us today so much, but that institutional money certainly is driving what we're seeing here in Seattle.
Absolutely. And it seems like what we've created is a bit of a tautological circle. Some of the things that we're going to talk about later in terms of metrics that make us a super positive environment right now, maybe have driven the rents a little bit. And that's caused some of our local political environment to shift towards maybe not anti-landlord, but it feels like that, we'll say tenant-friendly environment. And maybe you can walk us through some of the big heavy hitter issues facing landlords in Seattle. Mike, maybe move to the next slide here for us.
Yeah, and we definitely hear anti-landlord a lot, right? Whether it's true or not, that's how it feels sometimes. And so what this all comes down to is affordability. And, everything I just mentioned all has had an enormous impact on affordability, how we create no affordable housing, how we preserve affordable housing. And there's a lot of ways to do that, but it doesn't always seem like most of those are being considered. The way that at least Seattle and a lot of King County has tried to focus on affordable housing has been to try and keep existing units affordable, as opposed to trying to incentivize owners to keep them affordable themselves, as opposed to trying to streamline, affordable products throughout the city, and what's going to actually solve the issue, as opposed to just putting a Band-Aid on it, right? So some of the things passed, notable landlord-tenant laws, the SDCI, property inspections, which forces landlords to have their property inspected on a regular basis. The landlord, of course, pays for it, and depending on who comes out to inspect your property, they're all looking for different things. It seems like there's no real checklist that's been certified, and so different people find different issues. Just cause evictions, some of these items are probably realistic, but some of them, you have problem tenants, and it's a lot harder to get them out these days. And a lot of times those problem tenants are forcing other tenants to leave, break leases because, they don't want to live in the same community. The issue with deposits, how you can charge deposits and fees, and how they have to be spread out. And then of course the background check issue, which is still currently being challenged in court. I mean, obviously these are things that have been public. We don't need to go over them. There's, you can find a list of these on RHA's website. And then obviously a lot of changes just during the pandemic, right? Obviously you couldn't evict tenants for really any reason, unless they're doing something violent, essentially. The issue with that, same with rent increases, was there was no way to measure whether or not a tenant could actually pay rent. So a tenant who lost their job, the bartender whose bar shut down for a year, was being treated the same as an Amazon employee who was making $250,000 a year. And the problem with that is when you say nobody needs to pay rent, is the only person who takes the brunt of that's the landlord, right? And so if they had made it a little bit more, fair across the board, they would have told everybody, similar to how everyone banded together to wear masks and socially distance, said, if you can pay rent, you should pay rent. You should help out your landlord, help out the person who still has to pay taxes and insurance and utilities and make repairs. A lot of times that person's suffering too. We have a lot of clients who sold because they didn't know what else to do. And so some of these laws too are still in effect. I mean, some of those same people who make six figures are still not paying rent because they don't have to, and they don't feel like the repercussions are going to be that big of a deal. And then coming out of this pandemic, giving tenants, and in some cases this is probably warranted, but giving tenants 6 to 9 months to make up delinquent rent, giving them payment plans, guaranteeing legal assistance, guaranteeing they can stay in their lease even if they haven't paid rent. And so some of these other things, even though it feels like we're coming out of the pandemic, it still feels like we have a long ways to go as a landlord to get back to normal, even if rents are, returning to normal levels, concessions are starting to burn off, all good things, obviously, for the apartment market. It still feels like as a landlord, we're playing catch up, and we may be playing catch up for another 12 months or so.
Yeah, I'd agree with that. I think the way you and I were talking about it yesterday made a lot of sense, that it just didn't feel like a team effort. It felt like instead of the government saying, hey, landlords and tenants, let's all work together, it felt like this is pretty much all for the tenants, and landlords, you just go figure it out. On the bright side, because we handle so many evictions, while there is definitely a pileup of evictions that will be happening whenever the moratorium comes up, it doesn't feel like, especially at the higher end, like if you have a higher product, higher level, higher rent product, and Tim, you correct me if I'm wrong, while there are some abusers of that, as there always will be a few bad actors, it seems like on the whole, those properties are less impacted. Is that accurate, or just sort of?
Yeah, absolutely. And there's definitely, the more of the impact is going to be felt on the mom and pop who have a 5-unit and they have 1 or 2 people not paying rent. And that person's going to be affected more, because that's more likely going to be the landlord who knows their tenants, feels for them, and intentionally keeps their rent low. But if 2 tenants stop paying rent, there's 40% of the income, and buildings aren't making money if you've lost 40% of the income. And so the person if you own a 100-unit building and you got 2 people not paying rent, yeah, it's not going to affect you. You're barely going to feel it, right? You're not making the same cash flow you would, which doesn't feel good. But who are you trying to protect? And if you're setting this up to protect the person who's more apt to get hurt, it's the person who owns the 5-unit who's hasn't raised rent in 3 years.
Yeah, I would agree 100% that we're seeing a much higher impact on the smaller landlord, sort of mom and pop groups. And unfortunately, those are the ones you really want to incentivize if you want more housing availability, and you want to have specifically single family residences that are available for families to be in that category and then move up to buying. Those are the ones that I'm seeing, because we handle a spectrum of these matters. We're not always just trading multifamily buildings or skyscrapers or whatever. Those I've seen a lot more, where people are like, okay, I'm done. I can't take it. But on the multifamily side, we do see a lot of trading happening and a lot of activity. But before we get into sort of the positive stuff, one thing I did want to talk about is what you've seen in terms of the timing of development for permitting and contract rezones, and maybe walk us through how that's impacted your space.
Yeah, I mean, that goes back to what's the best way, what's the absolute best way to solve an affordability issue? I think it's the first day of your first economics class, if that's in high school or college, that you learn about supply and demand. And it seems like, that thought has gone out the window in a lot of cases. The best way to do it, and I'm not saying, throw a high-rise apartment building in every neighborhood, but it's to get these properties built faster. And that doesn't just mean affordable. And we have been building affordable housing, but it's market rate housing, it's student housing, it's affordable housing, it's senior housing. The more you can build, the more supply is created. You solve that demand issue, and prices will come down. There was a report that, about the beginning of this year, that said that Washington State underserved its demand for housing by 250,000 units over the last decade. And obviously, the vast majority of the population increase has been in Seattle and in King County. And so how do you solve that issue? You need to build more housing. So absolutely. Yeah, I mean, you want to break ground on an apartment, start permitting for an apartment now, even if it's a 20-unit apartment building in, I live out here in West Seattle. It's going to take you close to 2 years to be able to break ground. Wow.
Yeah, and that's probably twice as much as time as we would anticipate 10 years ago. And so I do remember doing a few deals earlier on in my career that seemed like the permitting process was easier. So we have maybe that's a good segue, but that's the one part of this that mystifies all of us from a local government perspective. Is on one hand, it's a crisis, a homeless crisis, and on the other hand, we don't want to do anything about increasing supply, and we want to really slow down development. And when you work with SDCI, a lot of times it's very positive, but you can catch an occasional individual or code section or requirement tagged onto your project that's just seems like the only way to interpret it is that they're working against you, which is unfortunate. It's not all the time, but that creates delay, and then we're all scratching our heads about what the real the real meaningful actions are going to be from a city council perspective and local governance perspective if we're going to see increase in supply anytime in the future. Now, onto the positive side of things, and this rebirth we've been talking about. Maybe this takes us into our next slide, Mike. We've just talked about some of the development issues. We can skip this one. And we're in an environment right now where I think, based on our discussion yesterday, Tim, very excited about buying in Seattle, and maybe walk us through why now is the best time to buy apartments in the city.
Yeah, I mean, if you're looking at this right now, it kind of speaks for itself. But I get excited about this. I mean, a lot of my business over the last 15 years has been in Seattle. The majority of it's been right in Seattle, and so because of the political things we've been talking about, because of the hoops you have to jump through, because of the negativity towards landlords, I'd say about 30% of all the clients that I've been working with over the past 15 years will say, I'm not buying in Seattle right now. And then another 30% are saying, I mean, I would buy in Seattle, but it's got to be perfect. And, anyone who owns real estate knows how hard it is to find perfect in Seattle. And this is what's happened. I mean, you look at King County, if you take out Seattle sales, 2019 through 2021, you've seen price per square foot go up 35 cents. You've seen price per unit skyrocket, and cap rates have slowly fallen. I mean, we're seeing cap rates in sales in Tukwila trade at the same cap rate that we're seeing in Capitol Hill right now. And that's not across the board. And that's, you've obviously got big rent differences and differences in who your tenant base is. But institutional capital is still desperately seeking opportunities in Seattle, in the region. And because of political headwinds, because of transportation and infrastructure issues, because of political issues, a lot of these buyers, all you saw about Seattle last summer, what was going on Capitol Hill, right? And so a lot of this institutional money was saying, I still want to be in that region, but I don't want to be in Seattle. And so while everyone's been focused outside of Seattle, we've seen the price per square foot, the price per unit, the cap rates all tip towards the buyer. And that's not to say that there's as many sales happening or sellers are as eager to part ways with their investment because they potentially have lost some value, and they haven't all lost value. But this is the least competitive we've seen Seattle in probably 10 years. And it feels to me, having worked through the last downturn, that it feels like we're in 2011 coming out of the Great Recession, and people are still a little bit scared to buy Seattle. And I think we can all agree that anybody who bought in 2011, whether they own it now or they sold it 3 years later, they were damn glad they made that purchase. And so I personally would buy something in Seattle last year. I actually bought something in Seattle last year. I would continue to put my money in Seattle if other people aren't going to jump on it. And so, I'll never compete with clients, obviously, but it just feels like, if you believe in Seattle, if you believe in it long-term, now is the time to buy. And I'll add that we do a lot of work. We work closely with our office team, the top landlord leasing team in the city, Greg England, Laura Ford, David Abbott, and Connor McLean. We work closely with them. And talking to Greg this week, a year ago, all this lease space was coming back on the market as sublease space. And then another 6 months later, all the sublease space is gone, but a lot of the new space hasn't been taken. And then as we're talking about it this week, he says there's no sublease space on the market. There's multiple new companies from California either moving up here or trying to open a second office. And then all the people we've been hearing about, the Facebooks, the Googles, all the biotechs in South Lake Union, they're all trying to expand here now. They're all trying to get back to work and get back aggressively, because a lot of them see it now as an opportunity to get in and maybe, get Seattle when it's not quite as competitive. And so I think you're going to see Seattle look completely different. I don't know how many people on this webinar have been downtown recently. Seattle looks a lot different than it did 6 months ago. And I think 6 months from now, it's going to feel like it did the end of, the beginning of 2020, beginning of 2020 into 2019.
Yeah, I'd echo that. I feel like I'm sure all of our listeners would agree that, or had this experience where you had your friends on the East Coast calling to ask if you were okay during the riots, and you're sitting there going, I work downtown, I'm totally fine. I've never felt threatened once from these riots. Like Seattle as a whole is not under siege. But the net impact of that was some of the bigger REITs and players kind of took a pause. And now I would say we're seeing a lot of activity, and it seems like that pause is over. Seattle's still Seattle. And to your point, Tim, about what it looks like in downtown right now, when you're walking around, yeah, it's summertime, so generally more people out, but it just feels like the vibrance of Seattle, and particularly the core, is kind of back. And to your point about office leasing, which is a big part of our business, we've seen a rampant uptick. Your analysis there is spot on. There was a lot of big chunky subleasing going on 5-6 months ago, and we are now back into doing new space that's never been occupied. And it seems like the naysayers are going to have to rethink their analysis, and particularly as we all learn how nice it is to be in the office with our teammates, which is a whole other discussion. So we'll keep this thing moving. And by the way, if you guys have questions, please start thinking about them. We're going to cover one more topic, and then we'd love to answer questions and make sure we get you some of Tim's sage wisdom here.
I'll add too as you're switching this. I think there's been a lot of talk about Amazon moving to the east side and how they're going to open 10,000 jobs. I mean, let's not forget Amazon still occupies millions of square feet in Seattle, and they own 13 buildings. Like I was down having lunch near Amazon today. It's not back, but it's not far off. And when Amazon's hiring 25-year-olds out of college and paying them $150,000, they don't want to live in Bellevue. They want to live in Seattle. Bellevue's great. Bellevue shuts down at 10 o'clock. I mean, you're in your 20s and early 30s, you're out having fun. You don't want to be told to go home and go to bed at 10 o'clock. And you want to be able to go to a concert, go to a ball game, whatever it is. I mean, Seattle's still going to be a popular option for even those people taking jobs over at Bellevue.
Yeah, and there's still just a different vibe in Seattle than the east side in general. I think those of us live in West Seattle, Magnolia, Madison Park, Laurelhurst. I mean, it's just a different vibe, and it's still very vibrant. So taking us to our next topic, while we try and keep this short and sweet for everybody, where are we at with debt driving demand? We hear a lot about low interest rates and how that's affecting values. Maybe walk us through that and what the net of that is. And then we've got a great sheet here too.
Yeah, I mean, I think this says a lot of it. I mean, obviously sales were hit drastically. The apartment sales market was down 65% in 2020 for obvious reason. There was no such thing as a value add. Tenants weren't moving. Tenants were delinquent. You couldn't fund anything because of delinquency, because of stagnant rent growth, all that kind of stuff. So low interest rates coming out of this pandemic is what has continued to drive these sales. It's the reason we've seen velocity start to pick up, and it's staying low. I mean, there's no real indication that this is going to change dramatically anytime soon. And so, you've seen back in 2019, fourth quarter, rates were about 3.7 on average. That's fourth quarter 2019 was the highest sales volume quarter of any quarter in the history of Seattle. That's obviously when the last quarter prior to the excise tax laws changing as well. But since then, rates have slowly fallen and, really helped to propel really all investment real estate arms. But, as we track apartments more, it's what's keeping this afloat. And if you can go buy, a 4 cap in downtown Seattle or in Redmond or in Bellevue and put debt on it at 2.5% to 3%, the seller hasn't lost any value and the buyer still feels like they're getting a good deal. So it's kind of the way we're keeping deals and keeping sales going at this point.
Right. And it does seem like time, if the mantra is time heals all wounds, with interest rates low like this, it feels like you're not doing so bad. If there is a little influx in the marketplace, you're kind of stabilized. It's not like you're out 5 or 6% like years ago we saw. Your institutional financing is still cruising along here at a rate that's sustainable for a long-term hold, right?
Mm-hmm. And we've seen some new debt funds if you're looking for a value add opportunity and you need somebody who's going to be a little bit patient, we're working with new debt funds who can put, bridge debt on a property that gets 3 years of IO at 3.5% that you can then either sell, once you've realized your value add strategy, or, roll into perm debt if that's your goal. And so, new kind of financing options have helped get some of these other projects that might be a little bit hairier, a little rougher around the edges, and still transact those.
Absolutely. So now we're going to take some questions from the audience if we have a few, but just so we're clear, if you want more specific information on this, Tim's widely available, and his wisdom on this we talk a lot about clients call and they say, hey, help me with this and that. We get into it. They're signed up. They're trading their building or whatever, and they ask, are we getting a good deal? And they go, you see a lot of these e-months. What do you think? And I always stop them. I'm like, you're asking the wrong guy. I follow the metrics across a number of industries, but the guy you ask is your broker. And so if you have questions that don't get answered today, make sure you reach out to Tim. The first question that we've got here, and you can type these into the little Q&A click thing, is what are people doing right now? What are people doing with their money? Tim?
Well, why are people selling right now if it's a good time to be a buyer in Seattle? I think that's a question I get often. And frankly, first off, there's just a lot of people who are scared about Seattle and the future of Seattle. Again, I'm not one of them. I don't think you're one of them. But because of what they saw last summer, because of a far-leaning city council, because of there has been talk of rent control, we could probably have an entire another webinar on that and why it doesn't work and it never has worked. But people just want to get out. We've helped a couple of people sell portfolios and move money into Central Texas, to Arizona, to Nevada, to Utah, Colorado, Florida, go buy apartments there. You can, a lot of times because of where values are in the Seattle area, you can go sell a, 10 unit at $300,000 a unit and buy a 30 unit at $100,000 a unit somewhere else. Just because of where we are. And so a lot of people are just trying to, take the risk, take the chips off the table and move it somewhere else. We've also helped a lot of clients, namely some older clients, move into stuff like Delaware statutory trusts or triple net properties where they can kind of set it and forget it, move into something where they're maybe selling a 4 cap, moving into a 5 cap. They've got a 25-year lease and it just kind of turns into mailbox money, more of a coupon clipper. And so,
yeah, the coupon clipper thing comes to mind if there was any response I have, it's like, well, maybe you slide some part of your portfolio into that. I don't see a lot of wholesale disposition of all the portfolios. If it's a movement, it's a slight movement to get to your point, the coupon clipper thing, your franchises that are just kind of known and doing okay. I don't know. I don't have any thoughts on whether that's a better play because I don't know the stability of those franchises, but some of them do pretty well. Another question we saw here is, or I'm seeing is, are you seeing a lot of movement as a result of a fear of an elimination of the 1031 exchange? I guess
yeah, I wouldn't say a lot of movement yet, but there is that talk. I think a lot of people on the outside looking in look at the 1031 exchange program essentially as a way for rich people just to trade in and out of properties. And frankly, it's the opposite. That program has helped a lot of people who don't make a lot of money start investing in real estate and actually being able to grow their wealth. When I got into business, one of my first few years, I worked with a family it was 2 teachers, husband and wife, 2 teachers. They raised 2 kids. They never made more than $60,000 combined in their entire career, but they were able to buy a single family house, rent it out, sell it, buy a 4-plex, refinance the 4-plex, buy an 8-plex, sell the 4-plex, buy a 20 unit. And, 30 years after they bought their first house, they're selling $6 million worth of real estate and exchanging into, they actually did do triple net properties. Sorry, they bought 1 apartment in the Tri-Cities and a triple net property, I think in Colorado, and they're now making $260,000 a year. And they never made more than $60,000 a year their entire career. And if you remove that property or remove that program, the 1031 exchange program, you really don't have that opportunity. Why would a wealthy family sell anything ever? If they can just continue to refinance, pull out money, buy something else, or, with the exception of people who need to satisfy investors, it's just, you'll see a lot less property changing hands and a lot more accumulation of wealth by the wealthiest people. And so I don't think it's going to go away. But we are starting to hear a lot more people talk about it and say, I might do something now just in case it goes away. So, it is a good time.
I would say, I'm not to cut you off, but there's an influx of some movement, but there's as much influx into the market and capital coming in to sort of take the place of it. So that's not really doing anything to the market. The other piece wasn't asked in the question, but kind of goes hand in hand is, what are the impacts of a net increase in capital gains tax? So you've held your asset a few years and you feel like you can get out at whatever your effective rate would be right now, if that's 15% or whatever, and you think that the current administration is going to raise that to 25% or get rid of a capital gains tax and just charge it all the same rate, then you're kind of quick to pull out. And I think we're going to see some volume increase in Q3, Q4 this year. But we saw that last year, with the excise tax. It was like a huge little run there because it was like, oh boy, everything over $500,000 is going to be, or $1 million is going to be 3% instead of that 1.78%. And, that stabilized. It wasn't something that's a long-term thing. So I think it's kind of a blip. And I hopefully people in the current administration and our legislature get the same story that you just told, Tim, because I think that's absolutely the truth. And I have several clients, maybe not the two teachers, but along those lines with the growth in their total asset base. Another great question we got is, how would you handicap the probability of rent control in the city of Seattle?
I mean, it first has to clear a hurdle at the state level. I mean, I think if the city council had the ability to go do it today, they would have done it 5 years ago, right? I mean, they've already been trying to do it, and they refuse to listen to any logic about why it's never worked in the past. And so they obviously don't care. They've already proven that they don't really care about, what a housing provider, seeks to do in the city and why things work the way they are. None of them own real, investment property, and so they're just not open to conversations like that. And so, what are the chances? Frankly, in the next 10 years, I wouldn't be surprised if there's some type of rent control, but likely it'll come in the form of what Oregon has done. In Oregon, in 2019, based on the rent control, you could have raised rents 10.5%, 10.3%, I think. And so if that's the case, you're not going to suffer that much. I mean, the investor who's going to come in, kick everybody out, do big renovations, and that there is a place for that type of investment. That will be more difficult, but I don't foresee, the type of rent control that, went into DC and New York and San Francisco in the 60s and 70s that just kind of shut everything down. I mean, I think there'll be more of a statewide program that, allows for more growth than Seattle would like to see. Oregon's is AMI plus 10% or plus 3%. And so,
which I think we touched on this yesterday. That means you could have still raised the rents by like 10% the last couple of years.
Yeah, 2019 would have been 10.3%.
Right.
Yeah,
and I'd support that. I think it's the overwhelming, so first off, city of Seattle is the high, and I'm pretty sure I get this right. Don't quote me on it, but the highest per capita education, like higher education, out of all the metropolitan cities in the country. So as an educated base, we can read and people understand what's happening in San Francisco, and they can see that that's probably something that would happen if we tried to attempt rent control in the city of Seattle. So we know what the results are everywhere else. And I feel like enough people have experienced that as well with the influx of tech workers coming out of those areas, that I feel like there's a high probability that there'd be a significant backlash to any proposal like that, even if they could get over the constitutional hurdle. Okay, one more question here before we break. What are your thoughts about inflation?
The best asset to own during periods of high inflation are real assets. I mean, if we really start to see some high inflation, I know we have in some goods. Obviously, lumber got a lot of publicity, jumping about 400% at the beginning of the year. That affected both of our clients. That's down a little bit, but still up, 200% since the beginning of the year. But the best thing to own during those periods is real assets. You'll see rent grow. You'll see less product get built, likely because the cost of materials, the cost of labor will also increase. And so just the cost to build, which is already incredibly high in Seattle, it'll take some period of adjustment, and owning something that's existing that has tenants that is creating income, you're likely to see that income grow during those periods. So if you're one of those who believes that we're in for a period of high inflation after printing so much money over the last few years, owning a piece of real estate, I think, is a good place. And again, that's where I'm putting my money.
Look, we'd like to thank everybody for coming today. That's been a great presentation. Tim, thank you for joining us. Again, if you have additional questions, reach out to Tim. He's a heck of a resource, and again, been a real solid colleague to work with on these transactions. Tim, thank you for joining us today.
Hey, thanks for having me.
And we look forward to seeing everybody next month or the month after. We will have a recap here. If you missed it or missed a part of it, it'll be available on the YouTube. our YouTube channel, and we'll see you in August. Everyone have a good and happy and healthy summer.
Thanks, guys.
Thanks again.
Thanks, Iman.